In today's fast-paced world, you need a partner with the expertise to protect identities, payments, and data, so you can secure what you've built, protect what you're building, and accelerate your growth. Entrust, securing a world in motion. Learn more at entrust.com/podcast.
You're listening to a Mint podcast brought to you by HT Smartcast.
Hello everyone and welcome back to another episode of the Why Not Mint Money podcast. Today, we are going to talk about two remarkable fund houses, Quant Mutual Fund and PPFAS Mutual Fund. But why are we talking about them? Recently, they both hit the 50,000 crore mark in assets under management. Apart from the stellar performance, they have little in common, says experts. Who should go for Quant Mutual Fund and who should invest in PPFAS Mutual Fund? We'll talk about this and much more in today's episode.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Nirav, thanks for coming again. And listeners, so this is a very interesting podcast. Out of the podcast actually. Interesting, I don't know, we'll have to figure out. But the thing we wanted to discuss today is two funds, right? PPFAS and Quant Mutual Fund. Both seem very different, but they have grown in a very similar fashion. Pre-COVID period, they were very small fund houses, but recently both of them announced that they have touched 50,000 crores. So have grown in a similar manner, but still very different. What's your thoughts, Neil?
So, Sachin, I went through the news bit on both of these fund houses crossing 50,000 odd crores, and the very first song that came to my mind was "Hum Dono Hai Alag Alag, Hum Dono Hai Juda Juda," which basically highlights how, two different events, although so seemingly similar, have their own unique and beautiful stories that has culminated into the point that they've reached right now. So I feel, PPFAS Mutual Fund and Quant Mutual Fund have very distinct stories and distinct claims to fame, and each one in its own right has really seen what could be called a meteoric rise, right? So I feel as we delve further into the conversation, we could talk about their own unique stories in a whole lot more detail, depending on which one do you want to talk about first and how do you want to take it.
Yes, and also Nirav, would you agree on this point? So PPFAS is a very good value investor, and Quant prefers to call itself a quant-based kind of investing style. They follow this investing style. But in this style, in both the respective style, let's take the first case, right? PPFAS follows a very similar style to Quantum Mutual Fund. And people at some point were comparing Quantum and PPFAS. But Quantum never took off like how PPFAS did. And on the other hand, Quant is relatively a new player, so to say, and there is this another fund manager called NJ, which, despite having a huge distribution reach, I think they're one of the largest distributors. They have not grown as much as how Quant has grown. So in a way, can we say that both are from different investing style, but both of them have done exceedingly well in their own category?
So it is very interesting how you actually, found peer comparisons within the industry for both of them. So I do often hear about how, PPFAS style reminds many of Quantum's investing style, and how, Quant Mutual Fund also, talks about quant-led models that NJ also talks about, right? So, the first half of the question focused on, why did these two do better than the other two? Although these styles are seemingly comparable, I would say that point number one, being similar is not exactly being same, right? So there is resemblance, but there is equal or more points of distinction that has led to these two funds do relatively better than their respective peer comparisons. The second thing to understand is growth in AUM. is a subject matter of a variety of factors. All right, it is not just performance, it is not just inflows, it is also somewhere related to your distribution capabilities, your retention capabilities, and how do you manage the business overall, right? So because at the end of the day, if we have to fit asset management companies into a conventional industry structure, they closely resemble the manufacturing layer, right? So they are manufacturers, they have products of their own, but the success of a manufacturer is not just about how good their product's quality is, but also how well it is able to deploy it into the market, how well are they able to penetrate it through the market, how well are the products being adopted by the market, what is the repeat cycle by the customers who bought it earlier. So something very similar also pans out here. So I feel AUM in itself, I feel while cheers and kudos to both mutual funds for crossing such an important milestone, I feel it is an important business milestone, but I feel that is where the importance and relevance of growing AUM stops, right? So it's a good business milestone. It cannot be attributed to one single factor saying that its performance was good, or its distribution was phenomenal, or its marketing strategy was good, or the brand value was good, or the customer retention. I feel it's a culmination of these things, and a culmination of these things has led to probably PPFAS doing better than Quantum Mutual Fund, and Quant Mutual Fund doing better than NJ in terms of business and assets.
So Nirav, also one more thing, we talk to a lot of mutual fund managers. You in the capacity of doing research and handling operations at Fisdom, and me obviously for writing articles and all. From your personal experience, different or similar are these two fund houses? So when you talk to Sandeep Tandon, who is the CEO of Quant Mutual Fund, and when you see Rajiv Thakkar talking, so where do you think they are similar and where do you think they are different?
Right. So, I have a few things that are similar at the outset is that both of them are really committed to building value for investors. Okay, they are really committed, and they are putting their heart and soul into delivering the best possible performance. Right. So I feel that is similar. However, the routes that they have taken are very distinct. All right. So when we talk to PPFAS, or if one were to take a sense, so at the outset, let me also point out, it's not as much about the way that they talk, but also the way that they act and what really reflects in their portfolio. Right. It's one thing to present a philosophy. It's another to stick to it, and it's another to drive results through it. Right. So both of them have definitely driven results through their philosophies. But when we look at PPFAS, they have a more high conviction, invest for longer sort of a style. All right. They want to take good, solid bets, sizable bets in, ideas that they have really high conviction in. It is almost textbook investing, wherein, one can draw inspiration from the various greats, and especially, I won't really call it as much as a value investing thing, because value investing, it is also as a concept, it can be interpreted in different ways, but it is clearly directed in that direction, at least, to say the least. Right. So that's how they manage their portfolio. If you look at the churn also, I believe over the past couple of months, it has been reasonably on the lower side despite all the volatility in the market. Right. It has been in the range of approximately 30 to 40%. Per se. So, but at the same time, let me assure you that low churn by no means is a measure of conviction. Okay. And, low churn could also, be interpreted in different ways. So one interpretation is you have really high conviction in what you're having, or two is you're not willing to reassess conviction in changing time. So there are different lenses with which that can be viewed. On the other hand, as long as we're talking about churn, at the very far end of the spectrum, we also have Quant Mutual Fund, right? The churn is relatively high, and I'm talking about as high as around something in the range of 200 to 300 odd %, which is basically, significantly higher, not even comparable as much, right? And again, at the same time, when I say there's a high churn, it is a particular style. A high churn does not mean that there is less conviction. Okay, it does not mean that there is no conviction in the stocks and you're always changing your ideas. At the same time, it does not even imply that you're trying to be highly opportunistic and take really short-term calls, sort of a thing, right? So I feel the right lens to look at both in distinction is that PPFAS as a fund house has stuck to taking limited bets, high conviction calls, and being very cautious before changing allocations and rebalancing portfolios, taking a very cautious stance, and clearly focusing on ensuring there is less risk involved, as much as possible, in terms of the exposures that's taken. At the other end, I would say Quant Mutual Fund is very specific about how it wants to capture upside and deliver alpha to customers. And as an investor, one would get the sense that Quant's single point mandate is to deliver performance superior risk adjusted performance across cycles. One gets a sense that it is not batting for relative performance. It's not trying to deliver an alpha just above the benchmark. It is trying to deliver absolute returns to the customers. It is trying to maximize returns, and they say that they are a data led fund house, and that leads to and that includes a variety of signals, including certain signals that could be high frequency or leading in nature, which could lead to preemptive churns within the portfolio. But quite often than not, it has worked in its favor. So a very clear example is in these styles is where PPFAS, for instance, just a case in point, holds around 27 to 30 odd percent into banking as a sector, right, as we speak. And at the same time, Quant Mutual Fund holds somewhere around 7.5 odd percent, which is significantly lower, right? Just recently, at Fisdom Research, we had this report on exposure to HDFC Bank, wherein HDFC Bank crashed really bad over the past 2-3 days. It dragged the Nifty, the bank Nifty also along. And so we checked the exposure. So, while PPFAS had a decent exposure, I would say, to HDFC Bank as an AMC, it is very surprising that Quant Mutual Fund completely dropped HDFC out of its portfolios, out of all of its portfolios. It is not, so PPFAS majorly has funds mobilizing in one of its fund. The majority is concentrated in the FlexiCap fund. Quant Mutual Fund has a diversified set of funds, around 25-26 odd funds, which makes it even more surprising. Despite having so many funds and having such a large index constituent, you don't take it in any of it. It is a really high conviction bet to make against such a stock and such a bank.
So these are very interesting points, right? First point you mentioned was on the churn, right? On one side you have PPFAS, which has one of the lowest churn rate, and on the other side you have Quant Mutual Fund, which probably has the highest churn rate. And interestingly, you released this report yesterday, and it showed that PPFAS has a high concentration in HDFC Bank, whereas Quant Mutual Fund has very low concentration in HDFC Bank. So Nirav, when I visited both their office, and quite frequently also, and one thing I noticed different in their office was how their team was structured, right? So you must have noticed when you go to the Quant office, there's a whole row of people sitting and doing the R coding. Right? R is a coding software, and 10 or 12 people just to clean out the data. And whereas PPFAS research room is a small room where there is one row and 4 or 5 people just sit and keep on reading books and annual report the whole day. So quite distinct office space also. But yes, expanding more on the AUM part, which you also mentioned quite a bit. On the one hand, PPFAS has a chunk of its AUM, majority of its AUM, and in one fund, that is the PPFS Flexi Cap Fund, and their design has been, to draw funds into this one flagship fund. Whereas on the other hand, one is launching NFOs left, right, center. So which one do you think is better? Focusing on one flagship fund and driving inflows there, or just launching a lot of NFOs, having all possible themes and categories possible and driving inflows that way. Obviously, it has worked good for both the player, but what would you prefer?
Yeah, so I feel it is for these are very distinct value propositions, right? So one would get a sense that PPFS major value proposition is that they will have one flagship fund, and they will run the flagship fund with the utmost flexibility. It's a flexi cap mandate, so they will be market cap agnostic, they will be sector agnostic. You look at the portfolio, you get a clear sense it's a bottom up style portfolio, right? And so they want to run a fund that is very flagship in nature, and which is all right to be included in anyone's portfolio, even as a starting fund or as a core portfolio fund, or something that they can very easily run an SIP into. So this is basically a product for everyone, sort of a thing, right? It is a product for the common man, the common investor, per se. Right. At the same time, of course, Quant Mutual Fund also has a flexi cap mandate, but at the same time, it has introduced various funds, and you notice various thematic sectoral funds also. Right. So I believe while the former makes it very easy for an investor to select a fund, once you believe in PPFS philosophy and its fund management style, you don't really need to worry about which fund are you picking. You want to invest in that flagship fund and play the upside in entirety over there. However, at the same time, while in Quant you can always choose the flexi cap fund, this also provides for slightly savvy investors who want to very carefully calibrate their own portfolios, or let's say investors who are assisted by portfolio managers or asset allocators per se, who really want to allocate towards certain themes, who want to create distinct core portfolios and satellite portfolios, and want to be on the right side of the market cycle, economic cycle, business cycle. So this offers the variety of choices to construct a portfolio, even through a modular route, right? You can put the blocks together and build any shape that you want, and if you don't want to do that, there's always the flagship flexi cap fund. So I feel these two are very distinct styles, and while the former offers the ease of choice, the second one offers the flexibility of choice. So basically over here exactly what you want to go with, what you're signing up for. In Quant Mutual Fund, you can use these small little products to construct a portfolio that you want to finally envision your money going into, right? So these are two distinct things, and one very notable thing, I just want to put this small point across, that while I'm not implying a direct correlation between the number of funds and inflows or AUM, it is also notable to know that wherever the AUM stands today, right, PPFS mutual fund took around 17 to 18 months to double the asset size to what it is today. And Quant Mutual Fund took barely 6 to 7 months to double it to where it is today, right? So it is not just so over here you can notice that PPFS is a slow building machinery which focuses on sustainability, consistency, etc. At the same time, very distinctly, Quant Mutual Fund has been winning hearts at a very fast pace, and the performance has been responsible for attracting a lot of such attention also in such a short span of time. Even if you look at the number of folios, I believe it's 55 odd lakh folios, right? So I feel it is not just performance driven but also number of folio driven. So it was a slight digression, but I thought it would help to just put it forth here.
Super interesting points that you mentioned. Nirav, would you remember how much AUM were they managing just before the start of COVID? Just a ballpark figure.
Just to ballpark, before the start of COVID, I would say, I mean, that's a really long time from now. I don't think I remember it as much offhand. At least now, because before COVID was a long time, and AUM is slightly difficult. But if I have to just think about it roughly, I feel PPFAS was around the range of less than 10,000 odd crores, probably at that point in time. It's a rough guess, okay? I don't have the numbers very handy right now, and I believe Quant was much lower, at that point in time. Probably in the 5,000 odd crores range. But don't take my word for it. I think I'll have to get back to the numbers to tell you for sure.
Yes, probably that would be the case. Quant would be much smaller, and PPF was also small, maybe managing $1 billion also, but both of them have had significant growth. Nirav, the last question, right? Although PPFS and Quant are very different, they have very different investing style. Who should go for PPFS and who should go for Quant mutual fund? And I was hearing Morgan Housel talking of different podcasts, and obviously Morgan Housel is the OG of investment writing, and everything he says, it's very hard and it's very true. So one thing he says is people debate between value investing and day trading or swing trading all the time, and he says that's because people play on the same field, right? It's like a cricket ground, and it's like, this is my example, but it's like saying spin bowling is better than fast bowling. So these are very different style, but since you're playing on the same pitch, people argue that, if investing is the right way to go or trading is the right way to go. But in reality, people, they are playing very different games, and apple to apple comparison is not possible. But that said, if anyone wants to invest their money, who should go for Quant and who should go for PPFS mutual?
Right. So, Sachin, you pointed it out really well. It was beautiful how you said that, when you're playing on the same field, there are two different styles, but both of them are playing very different games. And I feel, here as well, they are not quite comparable. Both of them have their own distinct styles. And, I feel we are at a point in life where everyone must acknowledge that, the world of investing is very complex and simple at the same time. So I don't feel it is either complex or simple enough to be classified between value style or growth style, or probably investing or trading. I feel these are shades of gray and not just black and white. That's important to understand, and every player is one particular shade of gray in here, right? So if we talk about PPFAS, which is touted to have a value bend, one must understand that value as a subject itself is very subjective, okay? And one must understand, like beauty, even value lies in the eyes of the beholder. So if you see value in it, then it's a value bet. If you feel you want to invest for the shorter term and you see some momentum happening in it, then it's a momentum bet, as simple as that. It really depends on your perspective. So for investors, getting back to the original question, what kind of investors should look to invest in either of the fund houses offerings? I would say, like I said, a common man deciding to start an SIP, just wants to start with something, invest for the longer term, does not want to get overwhelmed by choices, does not really know much beyond a point about the world of investing, and just wants to create good, consistent, sustainable returns. If that's the basic requirement, I feel PPFS funds are fantastic, and hands down amongst the best choices available for the common investor out there. For the SIP investors, I feel fantastic bet here. So at the same time, when I talk about quant funds, of course, even a common investor can also invest in a quant fund, but one must understand that it is important to be slightly savvy in terms of understanding how investing works and how equity works. It is important that one appreciates the style that Quant uses, because it could be overwhelming or intimidating at times as an investor when you see such higher churns, when you see your NAVs moving so frequently, and it could be slightly overwhelming. But I feel if you're slightly savvy and you are leaning towards moving up the investment curve and want to learn a whole lot more, or if you're savvy enough that you want to craft your own portfolios and maximize your upside, if you have that degree of savviness, I feel Quant mutual funds offerings are a sure shot bet for such investors.
Okay, Nirav, one last question and we can wrap up this podcast. All that GAN is fine, but where are you investing? Quant mutual fund or PPFAS mutual?
Both.
Wow. Nice way to wrap up the podcast. And yeah, thank you so much, Nirav, for coming to this podcast, and hope to see you again.
Absolutely. It has been a pleasure.
That brings us to the end of today's episode. If you would like to know more about this topic, then you can reach out to me on Twitter. I go by the username @SashinNJ, or LinkedIn using my full name, that is Sashin Ningthaukhongjam. We would be happy to take your suggestions. That's all from our side. Thanks for tuning in. See you in the next episode.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.